Greetings all and welcome to the Manifested e-learning platform. Today we embark on the revision of the Advanced Financial Management paper that was tested in August 2025. This paper has 5 questions. Today we are going to answer question number 1, which is in 3 parts, A, B, and C. First of all, we're going to answer part A of this question, which reads, highlight 4 reasons for soft capital rationing in a firm. 4 marks. Highlight 4 reasons for soft capital rationing in a firm. Candidates, there are 2 types of capital rationing. That is the hard capital rationing and the soft capital rationing. Now, the soft capital rationing is a rationing that is implemented by a firm by voluntarily imposing internal limits on capital expenditure, even if external financing is available. A firm may choose to limit its capital expenditure due to reasons within its control. So the question is, what are the reasons for capital rationing in a firm? In other words, why would a firm voluntarily impose internal limits on capital expenditure? The first reason. Let me answer this question on page 1. This is my first page, second page, page 1. August 2025, question 1. Reasons for soft capital rationing. Reasons for soft capital rationing. Now, the first reason is risk management and financial stability. Risk management and financial stability. What do I mean by risk management? Now, management may impose internal limits to avoid what we call over leveraging. That means taking on too much debt or over investing in potential risk ventures. So a company may have sources of spending, which could be external, like obtaining of debt, but the company may decide not to take on more loans, what we are calling over leveraging, taking on too much debt. And the reason is to reduce risk, is to manage risk, is to have what we call financial stability. And when that happens, the company maintains a desired level of financial stability and a healthy debt to equity ratio. So that's one reason, to manage risk and for the purpose of attaining financial stability. The second reason for capital rationing, number 2, is optimizing resource allocation. Optimizing resource allocation is to optimize resource allocation. That means focusing limited managerial talent and resources, and that happens when a firm restricts capital to ensure that only the highest return projects that align with the core strategic objectives are selected and funded. The fact that the company may have access to external borrowing, the firm should not always go for such borrowing, but the firm should ensure that there is optimal resource allocation. Or, in other words, prioritization of projects. The firm can do so, can attain optimal resource allocation by going for projects that are optimal. That's the second reason. The third reason is just maintaining management control. The third reason, maintaining management control. Maintaining management control. Now, the current owners or management may be reluctant to issue new equity because of fear of dilution of ownership. So because another way in which a company can raise capital is by issuing shares. So the current management or the current shareholders may refrain from doing so in order to ensure that they have what we call control, to maintain control, to avoid dilution of ownership, to avoid dilution of ownership and also voting power, or to ensure that the earnings per share is not reduced, which leads to what we call self-imposed restriction on capital. So the management of a company, the owners of a company may not want to dilute its ownership by issuing new capital. So that is another reason for soft capital rationing, which we said is voluntarily imposing internal limits on capital expenditure. That's the second or the third reason. Number 4, budgetary control. Budgetary control and incompetent management. Now, sometimes internal budgets are set as a rigid constraint in order to enforce financial discipline across departments, and that the reason is because when that happens is because the existing management team may lack the expertise or confidence to effectively seek, raise, or even manage larger amount of external capital. You understand? Incompetent financial discipline can be the reason why a company may have voluntary internal limits on capital expenditure. So candidates, these are 4 reasons for soft capital rationing. 1, risk management, financial stability. 2, optimizing resource allocation. 3, maintaining management control. And lastly, budgetary control. 4 marks. So that is the solution to part A of August 2025, question 1. We are now proceeding to answer the second part of the question, which reads, Ushindi Limited is considering the following projects, that is project A, B, C, and D. We are given the initial outlay, the annual revenues, the annual fixed costs in millions, and the project life in columns. Additional information, number 1 reads, variable costs are 40% of annual revenue. Number 2, each project is divisible. Number 3, project D and E are mutually exclusive. Number 4, cash flows are confined within the lifetime of each project. Lesson 5, cost of capital is 10%. Number 6, ignore taxation and depreciation. Number 7, the company has a capital limitation of 400 million shillings for investment. Number 8, all cash flows occur at anniversary dates. Required, Roman 1, the optimal allocation of the available capital to the projects, 8 marks. Roman 2, maximum resultant net present value from the optimal allocation. So candidates, this is a question. Roman 1, we are to calculate the optimal allocation of the available capital to the projects. You can see in note number 7, the company has a capital limitation of 400 million shillings for investment. So the company is considering investing the 400 million shillings, but the company does not know in which projects to invest because there are 5 projects, A, B, C, and D. So what projects should the company invest in for maximum return? That is what we are required to do. Now, to determine the optimal allocation of the available capital project, there are 3 steps. Number 1 is to first of all determine the cash flows from the project. What we have here is the annual revenue, we have the fixed costs, then we have the variable costs. These three items can enable us determine the present, the present value inflows. That's step number one. So let's have the solution on the board. Allow me to do away. So Roman 1 is optimal allocation, is to determine the optimal allocation. So the first step is to determine the cash flow for each project, and to get the cash flow for each project, we are going to deduct the variable cost from revenue. We deduct the annual fixed cost from the revenues, then we'll have the cash flows, which will be in future terms, the future cash flows. Then we'll have to apply the present value annuity factor on the future values to get the present value of the cash flows. That's the first step. That's step number one. Step number one, determine cash flows for each project. From each project. Determine cash flows from each project. How many projects are here? These are 5 projects. So we have a row for projects. The first row for projects. We'll have one row, C, D, and E. So the first is annual revenue. Annual revenue, these amounts are in millions, so we indicate amounts in millions, shillings in millions, shillings in millions. So we have the annual revenue provided in the question. The annual revenue for project A is 200 million. Project B, 300 million. Project C, 80 million. Project D, 170 million. Project E, 80 million. We will deduct the variable cost from the revenues to get the contribution. We read from the question that variable costs are 40% of annual revenue. We are going to have a working here for variable costs. Working number 1. Workings number 1. Variable costs for project A be 40% of 200 million. For project B, going to be 40% of 300 million. Project C, 40% of 180 million. Project D, 40% of 170 million. Project E, 40% of 80 million. These are the variable costs. So I take my machine and calculate the variable cost. This one without even the machine, this is just 32 million. 32 million. Not 32, but 80. 80 million. Then the second one, 40% of 300, this is 120 million. Then you have 0.4 times 180, 72 million. 40% of 170, this is 68 million. E, we have 40% of 80, 32 million. So we plug in the variable costs, 80, 120, 72, 68, 32. Deduct the variable cost from the annual revenue to get the contribution. So contribution project A, 200 minus 80, 120. Project B, 300 minus 120 is 180. Project C, 180 minus 72. 180 minus 72, this is 108. Project D is 102. Project E is 48 million. From the contribution, we are going to deduct the fixed cost for project A. From the question, we have the fixed cost there, 50 million. Project B, 100 million. Project C, we have it at 60 million. Project D, 80 million. Project E, 20 million. Then after deducting the fixed cost from the contribution, we are going to have the net cash flows. Net cash flows, project A, 120 minus 50, this is 70. Project B, 180 minus 100 is equal to 80 million. Project C, 108 minus 60, 108 minus 60 is 48 million. Project D, 102 minus 80, 102 minus 80, 102 minus 80 is 22 million. Then 48 minus 20, this is equal to 28 million. So these are the net cash flows. Are you following, candidates? These are the net cash flows. Future cash flows. Next step is to discount the future cash flows, multiplying the future cash flows with the present value annuity factor. We multiply the future cash flows with the present value annuity factor to get the present value, of these future cash flows. Now, the examiner has been providing these present value annuity tables. During this sitting, the annuity tables were not provided. Where the annuity tables are not provided, you are required to calculate the present value annuity factors using the following formula. So you have the formula for present value annuity factor. How do you calculate the present value annuity factor? We know the discounting rate from this question is 10% R. So the formula for present value annuity factor is 1 over 1 plus R raised to N over R, where R is the discounting rate, N is the period. For what will be the present value annuity factor for project A? From the question, we have the period for each project. For project A, the period is 3 years. Look at the question. The period is 3 years. Look at the question. The period is 3 years for project A, 5 years project B, 4 years project C, 10 years project D, and 15 years for project E. So first of all, we are going to calculate the present value annuity factor for project A. The period is 3 years. So we're going to plug in the period and the rate in this formula. So we have 1 minus 1 over 1 plus R. 1 plus R. The discounting rate is 10%. Convert 10% into decimal, we have 0.1. So 1 plus 10% or 1 plus 0.1 equal to 1.1. We raise it to the period of 3 years. Divide by the rate, which is 10%. Convert 10% into decimal, 0.1. So this is going to give us the present value annuity factor for project A. The period is 3 years. So we plug in calculator these figures. This is going to give us 1 minus 1 over 1.1 raised to 3. This will be equal to 2.48, equal to, let me just write it here, from the calculation 2.4869. We come to the second project, project B. Project B's life is 5 years. 5 years. The life here is 5 years, so we change here from 3 to 5, then we get the answer from the calculator. So we have it 1 minus 1 over 1.1 raised to 5 over 0.1. This is equal to 3.79. 3.79. This is 3.7908. Next is the present value annuity factor for project C. Project C's life is 4 years. We raise this to 4. Then we calculate it from the calculator. 1 minus 1 over 1.1 raised to 4 divided by 0.1 project C. This is equal to 3.16. 3.1699. Next is project D. The life for project D is 10 years. So we raise this to 10, then we calculate it. 1 minus 1 over 1.1 raised to 10 over 0.1, 10 years. This is 0.144. This is equal to 3 point. We raise to 10. This will be equal to 6.144. Then lastly, this has a life of 15 years. This is 10 years. This is 4 years. For 15 years, we come and substitute here with 15 to get the present value annuity factor at 10%. So I have 1 minus 1 over 1.1 raised to 15 over 0.1. This is equal to 7.061. So these are the present value annuity factors, and we have determined these factors using this formula. So candidates, you are required to memorize this formula before getting into the exam, among other formulas. There are times when the factors are provided in the question paper, but in August 2025, the annuity factors were not given. So let's now calculate the present value. The present values for each project, we calculate it by multiplying the present value annuity factor with the future value. So the first case here is 70 times 2.4869. This is equal to 174.083. The next one, 80 times 3.7908. I punch here, so the answer is 303 or 3.264. Next, you have 48 times 3.1699. This is equal to 152.1552. Next, you have 22 times 6.1446. 22 times 6.1446 is equal to 135. Is it 135? Yes, 135. 135.1812. Okay. Next, we have 28 times 7.6061. 28 times 7.6061. 212.9708. So these are the present values. These are the present values. So that's the first step. Calculate or determine cash flows of each project. So these are the cash flows expected to be derived from each project. Understand, candidates? That's step number 1. Step number 2 is to calculate the profitability index for each project. Profitability index for each project. Determine, step number 2, determine the profitability index for each project. Because it is this profitability index, it is on the basis of the profitability index that we are going to rank the projects. You understand? Yes. So we will have another working for profitability index. Profitability index. Present value inflows over present value cash outflows. Present value cash inflows over present value cash outflows, or initial investment. The initial investment. So we have the cash flows here. From the question we have the initial investment project. So the profitability index for project A, profitability index for project A will be equal to 174.083, 174.083 divided by, from the question, what is the initial outlay? The initial outlay there is 100 million. 100 million. For project B, we take 303.264, 303.264. We divide by the initial outlay from the question. Project B is 300 million. Project C, present value is 152.1552. We divide by the initial cash outlay. Project C, initial cash outlay is 150 million. Then there is project D. Project D's present value is 135.18.12. Divide by the initial outlay for project D. Initial outlay for project D from the question is 120 million. Then project E, the last project, present value is 212.9708. Divided by the initial outlay here is 180 million. So this will give us the, so I go to the machine and do the calculation. 174.083 divided by 100 without the calculator, this is just 1.74083. The next one, 303 divided by 300, this is equal to 1.01088. Then next one we have 150, this is 152.1552 over 150. This gives me 1.036. Next in line we have project D, 135.8188 divided by 120. This gives me 1.1265. Then lastly, 212.9708 divided by 180. This is equal to 1.18317. So these are the profitability indices for each project. Now it is on the basis of these projects, the profitability index, that we can then rank. We can now rank these projects. The project with the highest profitability index will be undertaken first. And you can see project A has the highest profitability index. So this one is ranked number 1. The second one in line is, this is 1.7, 1.0, 1.0, 1.2, 1.12. This is 1.18. So this is ranked number 2. Then this one is ranked number 3. All right. Between this and this one have 1.014. This is 1.010. So this one is ranked number 4. Then this is ranked number 5. So we've done the ranking. Are you following, candidates? So determine the profitability index for each project. We have done it here. Then based on the profitability, we rank projects. These projects are ranked there. But what is the question? Look at the question again. What is the question? What is the question? We are required from this question to determine the optimal allocation of the available capital of the projects. The available, okay? Optimal allocation of the available capital to the projects. How are you going to allocate the 400 million? So we've seen the first project that should be undertaken is project A, because it promises the highest return based on profitability index. So this one is first undertaken. And what is the initial cash outlay for project A? The initial cash outlay for project A is 100 million. All right, this is shillings in millions. We read from the question, candidates, you recall that project D and E are mutually exclusive. So we have the second project to undertake here is project E. What cash outlay for project E? The cash outlay for project E is 180 million. So here we have 180 million. After undertaking project 1, out of the 400 million that is available, the next project to undertake is project E, and it requires 180 million. The third project to undertake is project D. But we've read from the question that project D and E are mutually exclusive. That means that when one of these projects is undertaken, the other one is not undertaken. If you choose project E, then project D has to be forgone. So between these two projects, we choose one. And which one do we choose? We choose the one that promises the highest return, and that is project E. When project E is undertaken, project D is forgone. So this one, we don't allocate any money. Meaning that the next project to undertake is project C, because it is ranked number 4. How much is required to take this project? It's 150. The cash outlay here is 150 million. Are you following? Are you following? So out of the 400 million, first invest in project A, 400 million. Then project B, 180 million. Then we have project C, 150. Well, let's see what will be the total. What is the total there? Project C. Is it 120? Project C. Project C. Initial outlay, and let's check again. The initial outlay for project C is 120. This should be 120. Should be 120. Okay. So this should be 120. 120. So suppose 120. So this is the optimal allocation, because if you get this total, you'll have 120 plus 180, that gives you 300, plus 100, that would be 400 million. So 400 million is allocated by, first of all, investing in project A, then project C, then project E. That is the optimal allocation of the available 400 million. So we've answered the question. Optimal allocation is project A, project C, and project E. So we've done the first part of the question, that is 8 marks. Then look at the question again. We have part 2 of the question, maximum resultant net present value. Maximum resultant net present value from the optimal allocation. Okay. We are answering the second part, candidates. Required maximum resultant net present value from the optimal allocation. From the optimal allocation. If the company is going to invest in project A, project C, and project D, what will be the resultant NPV? Roman 2 is to calculate the resultant NPV of the project. We know, candidates, that NPV is equal to, we know the formula for NPV. NPV is equal to the present value cash outflow minus the present value cash inflow. All right? Yes. NPV is equal to the present value cash outflow minus the present NPV is equal to the present value cash inflow. Okay, this should be inflow. Present value inflow minus present value cash outflow. Cash outflow. We deduct the outflow from the inflow, we get the NPV. Now for project A, the present value inflow. What is the present value inflow? The present value inflow, we had determined it here. The present value here it is. So project A is 174.083. We deduct the initial cash outlay for project A. The initial outlay for project A is 100 million. So we minus 100 million. That will be the NPV for project A. Project E. Project E. Project E. So we have it here. Project E. Project E's cash inflow. Project E is 212.9708 minus the initial cash outlay for project E. Initial cash outlay for project E is 180 million. So 180 minus 212. So we have 212 minus 180. This is 212. 212 minus 180, 32. So I'm getting here 32 point. This is 32.9708. Then the third project is project C. Okay, project C. Now this project C, you can see, candidates, the company first of all invests in project A, which requires 100 million. Project B requires, the project requires 180, giving us a total of 280. I want you to follow keenly here, candidates. Let me use this space. So we have here, the first project requires 100 million. The second project requires 180 million, giving us a total of 280 million. There is a limit on capital of 400 million. So we deduct 400 million from this 280. How much is it? This is 400 million minus 280. How much is it? 400 million is the limit minus 280. 150. This is equal to 150 million. And you see, candidates, to invest in project C, to invest in project C, this project C here, there is 120 that is required. And we've also read from the question that these projects are divisible. The projects are divisible. The projects are divisible. So the company, you can see, after investing in these two projects, the remaining capital is 150 million. 150 million is at the disposal of the company to invest in the next projects. You understand? Yes. 400 minus 280 is 150. To invest in project C, the company requires 120 million. And don't forget, candidates, we are calculating, we are determining the resultant NPV. The resultant NPV. So how do you calculate the resultant NPV for project C? We have the present value cash inflow of 152.1552. That is the cash inflow. From this cash inflow, we deduct the initial investment. The initial investment, project C, we've seen, is 120. It's 120 million. So from this, we are going to apportion. We apportion it because we are going to do what we call apportionment, because this project requires only 120 million. Requires 100. The company is not going to invest the whole amount of 150, because to invest in project C, the company only requires 120. So we are going to apportion it. So we're going to have 120 over 150. We apportion to get the resultant NPV for project C. So how much is it? So I have 152.1552 minus 120 times 120 over 150. This is equal to 1.72416. So then we get the total, and that will be our answer. We are going to add these three. So we add the three, 74.083 plus 32.9708 plus 1.72416. That gives me the total of 108 is 108.77796. So the resultant NPV is 108.77796 million. That is the resultant NPV. That is the resultant NPV. That is the maximum resultant NPV from the optimal allocation. From this optimal allocation, the resultant NPV is as provided there. Clear? Is there any question? If you have any question, please, below this video there is a comment section. You can send in your question. That is part 2 of part B. Then we move to answer the next part of the question, which is describe 4 advantages of the Eurobond. Describe 4 advantages Eurobond market offers over a domestic bond market that makes it an attractive way for companies to raise capital. So here we are comparing two things. We are comparing two things: the Eurobond market and the Eurobond market and the domestic market. Four advantages of Eurobond market over domestic bond market. Advantages of the Eurobond market over the domestic bond market. Now, candidates, what makes the Eurobond market more attractive than the domestic market? That's the question, right? Why would companies prefer sourcing from the Eurobond market over the domestic market? Now, the Eurobond market offers several advantages over a domestic bond market that makes it a highly attractive way for companies to raise capital internationally. And one advantage is the wider access, all right? Access to wider and more diverse investor base. Wider, diverse investor base. Access to wider, let me write access to a wider base. Access to a wider market. Access to a wider and more diverse. That's the right word. And more diverse investor base. Eurobond candidates offers a wider and more diverse investor base because Eurobonds are issued and traded internationally across different countries, and are marketed to investors globally. And that gives companies access to massive pool of global market, which is more or much larger and deeper than the investor base that is to be found in a single domestic market. So that's the first advantage. Access to a wider and more diverse. There is a second advantage associated with flexibility. The Eurobond market is more flexible. There is flexibility in currency choice. The Eurobond market offers flexibility in currency choice. It offers flexibility in currency choice and hedging, because a company can choose to denominate a Eurobond issue in any major currency, regardless of the country where the bond is issued. And that contrasts with the domestic bonds, which are typically issued in the local currency. And this flexibility then allows a multinational company to issue bonds in currency that best matches its revenue streams or foreign capital needs. That is a very strong benefit or advantage. Less stringent regulatory environment. The European market does not have strict regulatory requirements as compared to domestic bond market. Eurobonds are generally not subject to strict regulatory oversight of any single national financial authority, such as the Nairobi Securities Exchange, and that often results in less documentation. It results in less administrative costs and also faster issuance process compared to issuing in a domestic market, where a company must comply with the local rules and regulations like those that are offered by of the Capital Markets Authority or the Nairobi Securities Exchange or any regulatory body. Stringent regulatory environment. Then lastly, there is potential for lower borrowing costs. The Eurobond has potential for lower borrowing costs. The Eurobond market has potential for lower borrowing costs. Issuers can strategically choose the currency or the country of issuance and the currency to take advantage of the lower prevailing interest rates in any market, right? Compared to their home country. So the large, liquid and competitive nature of the international Eurobond market means that borrowing costs like the coupon rate can be more competitive than what a company might face when constrained to its domestic market. So these are four advantages that the Eurobond market has over the domestic bond market. One, we said there is that access to a wider and more domestic investor base, diverse investor base. Number two, there's flexibility in currency choice. Number four, there are less stringent laws, regulatory environment, and then there is a lower borrowing cost, potential for lower borrowing costs. So these are four advantages the Eurobond market offers over domestic bond market that makes it more attractive way for companies to raise capital. And that's the end of our today's lesson. We've answered the question that was tested in August 2025 question 1. Thank you for attending the lesson. We will continue to provide more solutions for the advanced financial management paper. If you have any questions, or if you have any question that you want us to solve for you, please feel free. Write to us. Our numbers are open. We are here to serve you. Bye-bye.